Hello legends, it's Guan here. Good to see all of you here today. Thanks for tuning in for today's video. We'll be looking at the infamous price to earnings ratio and find out the nuances as well as how to best use it and how to not use it. So in this video, I'll be covering 4 major aspects. Number 1, understanding PE ratio and how to calculate it. Number 2, the best scenario to use it. Number 3, the worst scenarios to use it. Number 4, summary. Before I start, let me caveat it here first. I may be using businesses and stocks interchangeably. So, without further ado, let's get ready for a ride. Let's illustrate this. There are now 2 burger stalls. Burger stall A makes $50,000 of profit per annum, whereas burger stall B makes $10,000 profit per annum. Maybe the burgers were meh as compared to burger stall A. Let's say that the owners of both burger stores are reaching retirement age and they don't intend to continue the business anymore, so they put up offer prices. Now, burger stall A is selling for $100,000, whereas burger stall B is now selling for $50,000. Now, suppose you're interested in buying a burger stall business and operating it. This is the moment where you can make use of the PE ratio. Let's now look at burger stall A. Selling price of burger stall A is $100,000 with an annual profit of $50,000. Therefore, the price to earnings formula equals to selling price divided by yearly earnings or yearly profits. $100,000 divided by $50,000, you get a PE of 2x. This tells you that if you were to buy the business at $100,000, you're paying 2 times of its annual profit for what it's worth. Let's look at burger stall B. Selling price of burger stall B is $50,000, an annual profit of $10,000. So the PE for burger stall B would be $50,000 divided by $10,000 of profit. You will get a PE of 5x. This tells you that if you were to buy burger stall B at $50,000, you are now paying 5 times of its annual profit for what it's worth. So from here, assuming both burger stores sell at the same variation of burgers and the quality of workers are equal in work performance, you'd probably want to buy the burger stall A, as you're only paying 2 times of its annual profit. Assuming you make no changes to the burger stall business A and the burger stall annual profit estimated to be around $50,000 as well, you could then get back all your money within the 2-year time frame. Now, comparing this with burger stall B, you are now paying 5 times of its annual profit for what it's worth. That means you can only get back all your money in 5 years rather than 2 years. Now, you tell me if this burger stall B is worth the cheap price tag of $50,000? Make sure you comment down below. Be sure to like and subscribe, and don't forget to ring the bell icon. Let's illustrate it using Microsoft as an example. Go to Yahoo Finance, Microsoft. You will notice PE ratio TTM. The TTM here means trailing 12 months. A PE TTM of 37.84 means the stock is now trading at a price of 37.84 times of its trailing 12-month profit. In this example, what this really means is if you have $2 trillion to buy the whole of Microsoft, it will take 37.84 years to return all your money, assuming the earnings do not grow further. Let's illustrate it using Apple as an example. Go to Yahoo Finance, Apple. You notice PE TTM of 31.45. It means Apple stock is trading at a price of 31.45 times of its trailing 12-month profit. Again, in this example, what this really means is if you have $2.3 trillion to buy the whole of Apple, it will take 31.45 years to return all your money, assuming earnings do not grow further. Now, by this logic, assuming the underlying technologies do not change drastically over the several years, an investment in Apple may seem to be a better deal than Microsoft, given all other variables stay constant. But, of course, here's a big caveat. The reality is that nothing is static and constant in business and in life. Therefore, you need to look into other ratios as well as the other qualitative aspects of the businesses in order to help justify your investment decisions. The best scenario to use it. It's best to be used when you need to compare different businesses or stocks of the same category. For instance, the burger stores example and Microsoft and Apple examples. And people often say that you only compare Apple to Apple. Yep, totally pun intended. This is the accurate representation of the PE ratio usage. The worst scenarios to use it. Now, scenario A. Likewise, let's say you now compare a manufacturing business with an internet e-commerce business. You wouldn't get meaningful results. This is because the two business models are vastly different from each other. This means different cost structure, different monetization strategies, different customers, different services, different products, etc. So all this leads to this statement. The business growth drivers are entirely different in each company. There is no similarity here. Scenario B. When a business recently sold off one of its divisions to another business and earned an extra profit gained. Now this is not a recurring transaction, and therefore you need to adjust the net profit calculation by taking the net profit as reported minus the reported extra profit gained to calculate the true net profit. You will then proceed to calculate the PE ratio using this adjusted net profit. Now, scenario C. When a business's profit is badly affected due to a sudden crisis. Take COVID-19 for example. Many manufacturing businesses are affected by the COVID-19 pandemic. Therefore, this means much of the net profits are severely affected by it, creating a scenario where everyone will think this business is too expensive, when in reality, the business has no fundamental problem and is just a seasonal impact due to COVID-19. Therefore, giving it a false sense of PE ratio, making it look expensive. Another obvious example would be when you're trying to value a business that is or has been making losses. Since there is no earnings, you can't measure the business using the PE ratio. Now, in this case, you might want to use other relevant metrics. Therefore, I have to stress this again. You need to look into other ratios and the qualitative aspects of the businesses in order to help justify your investment decisions. Now, summary. In a nutshell, PE ratio is useful to be a guidance, but definitely not the only ratio in justifying your investment decisions. Once again, thank you for riding this journey with me. Make sure you smash the like button and subscribe, and don't forget to comment down your thoughts below. I will see you in the next one.